Thank you for confirming. So, welcome everyone to this first session on permanent establishment. Uh, my name is Arinjay, and I'm a chartered accountant who's been practicing into international taxation for around 24 years now. So, some of you who might have been through my earlier courses are aware in terms of the content and everything we do. But I basically teach international taxation and UAE corporate tax. As a part of this series, this is a particularly one on permanent establishment. And what we're going to do is over the course of next 5 sessions, we are going to look at various aspects of permanent establishment. So this is basically how our 5-day curriculum is something that would look like. So today we'll deal with the introduction of permanent establishment, and I would also take you through in terms of, how you're going to get updated on various sessions that are going to take place. Tomorrow we'll deal with the fixed place permanent establishment and agency PE. Day 3, we will have service PE and construction PE. Day 4, we will have attribution of profits and global trends. And day 5, we'll just look at practical challenges and mock case studies. Now, there are two ways we can do session 5, which is one, I can choose certain set of case studies, but in case you have any suggestions, you can drop them. So that's to make this session a bit more meaningful and more interactive from the perspective of everyone. Now, in addition to this, some of you had issues today in terms of joining this particular session. Now, I just want to take you through this particular section, which when you would have logged in, you would have got this. So once you get on our website, there are these few buttons which are there. If you look at the feed section will basically cover whatever content, update, or material might have been shared in connection with the course that you have been enrolled into. So let's say if you are enrolled in permanent establishment, you will be able to see the feed relating to permanent establishment. If you are a part of the international tax course or the UAE corporate tax course, you will be able to see all the feeds and posts relating to that particular topic. In the workshop section, you will get the links which are for all the sessions that are going to happen in your particular case, right? And all of these links are activated 15 minutes before the call. You will get two reminders, one 24 hours before the call and one half an hour before the call. In case you still don't get an email, just check your spam folder, and that should be something which will help you. The courses section basically contains various courses, some of which you might be subscribed or otherwise. Why this is relevant is once all the sessions are completed, we are going to add it as a course here, and then you will have access to the recordings of all this course, even after the live sessions have ended for the duration, which is something which is mentioned out to you. And the last one is the messaging section, depending on, again, the course that you are enrolled in. So let's say if a person is enrolled in the PE course, they will be able to see the messages, the updates, etc. for the relevant course. So now moving on to what we have today, I would prefer that, if we have this session a bit more interactive, 5 hours devotion to a PE can only happen in a situation when you ask question, when you ask things, and we look at things in that perspective. A few housekeeping rules as you will get into the community, because that we are trying to see if we can make that community a more descriptive one where one can ask their question and the others can also assist them. A few housekeeping rules which, based on our earlier experience, we've had issues which we just want to clarify is, whenever you are interacting in the community, please stay on the topic for which you are there. I know each one of us has various issues in terms of different aspects which we are dealing with, but please stay on the topic for which you are participating. If you are participating in income tax, please don't put in GST, VAT, or other concept in there. The community is meant for a specific purpose. Please keep that to it. Please don't spam the community with, unnecessary links, marketing stuff, and everything. Just be professional and respectful when you are replying to other members. If you are quoting something, just put some reliable sources. Please don't pick up the chat GPT stuff and put it in the community. You are doing a disservice to yourself and the others. There should not be any soliciting of clients or sharing contact details in the community, because it is for your benefit only. We don't want it to become another situation where, people are just sending 100 messages and the one who are interested really become disinterested and leave. Please, if a person has already shared something, don't duplicate it or don't put irrelevant things. And a must, don't put any copyrighted materials of others to which you don't own. If there's a Deloitte publication, put a link to Deloitte publication. Don't put in that stuff there. Please be confidential. If you're sharing data or if you're asking question, don't quote your client names, etc. Anything which goes against this, we will just remove that person from that community. That community is just a add-on service to you. You still will continue to have access to your courses, but anyone violating these rules, we will remove them from the community. However, if you have any professional questions, etc., please put them in, and please also support others who might be in need. So now moving on to the topic for which we are beginning today. This is around the concept of permanent establishment. Now, when we talk about permanent establishment, uh, one first needs to understand why is this even relevant, right? And what exactly does a permanent establishment means? For this, one needs to understand how international trade and business actually works. So generally what happens is, for any two countries, whenever a transaction is happening, although they can be in more than two countries also, whenever a transaction takes place, that takes place between a person who's doing a transaction and the other party. Now, if both of them are resident of the same country, it doesn't matter, because in that case, one person receives income, the other one gets expenses, right? Maybe in case there isn't some exemption available to the recipient, it's an otherwise there's a tax neutrality aspect which is involved there. But when a transaction takes place between two people who are resident of different countries, so let's say, for example, let's take case of a US company which purchases some goods for, let's say, $80 and sells it at $100. Let's say the profit they earn here is $20. Now, this income is liable to tax. The purpose of double taxation avoidance agreements, which are also known as tax treaty, is to avoid the taxation of this income in both the countries, because that will impact cross-border trade and will reduce it. So the desire of every country is that if there is a person who's earning income, US may desire that this $20 should be something on which tax should be paid in US. Let's say this US company is a tax resident of USA. USA would want that on this $20, tax should be paid in US. Let's say, for easy purpose, let's say the tax rate here is 30% and the tax rate here is 20%, 25%, right? Now, US would want that this income should be taxed at 30% in the USA, which means that $6 worth of taxes should be paid here. Whereas India may want that on this $20, 25% taxes may be paid in India, which is $5. Right? The problem with this is that if a person ends up paying $11 as taxes and he gets $9 as income, he may not be very, very interested in doing cross-border taxes, cross-border transaction. In this case, if instead of 20, even if he earns $15 by selling the goods within USA and he pays 30% tax on it, he will be left with 15 minus 4.5, which is $10.5. So he may prefer doing business locally as against globally. The purpose of double taxation avoidance agreements is that this double taxation is not triggered, and these two countries enter into an agreement whereby the taxes are either paid in India and US doesn't charges those taxes. The second is taxes may not be paid in India, it may be paid in US only. Or the third is some part of the taxes are paid in India and some are paid in US. Effectively, ensuring that there is no double taxation. This fundamental concept applies to each and every type of income in international taxation. Where the concept of permanent establishment comes in is in the case of taxation of business profits. Now, what I mean by this is when we talk about the taxation of business profits, different people may have different things which may constitute business for them. Some people may be doing consulting services which may constitute business for them. Some people may be doing sale of goods, like in our example, which may constitute business for them, or otherwise. Now, the taxation of business profit is decided on the criteria of whether the non-resident, let's say the seller is in US, the buyer is in India. The taxation of this $20 is dependent on whether this US company has a permanent establishment in India. Now, what exactly is permanent establishment? This concept is something which is very, very fact-based and accounts for a large part of litigation in international taxation. A permanent establishment, in simple terms, means that the US company has some form of a presence in India, which is more than a casual or has some degree of permanence. Right? Now, as a foreign company starts planning their operation, in terms of this presence, this basically can be in the form of a company, or it can be form of our branch. These would be when they have legally incorporated things. The other methods which also constitute PE could be in the form of an agent, could be in the form of a site, etc., which are there. But predominantly, when a foreign company looks at operating in another country, they've got two options. One is they set up a company which does all the local activities, or they set up a branch which takes care of all the activities. If they set up an Indian company, this Indian company, whatever activities it does, it is going to earn profit out of these. And on that profit, it pays the domestic corporate tax. If the foreign company has a branch, this branch by default is treated as a permanent establishment of the foreign company. The difference between the two is, whereas the Indian company would pay corporate tax at 22% plus surcharge or 30%, whatever rate might be applicable for them, a branch is taxed at the rate of 35% currently, which was reduced from 40% earlier. Right? So the existence of a PE also depends on whether you incorporate a company or you incorporate a branch. Now, again, here there may be one question which keeps on coming, which is that even can a subsidiary also become a permanent establishment? And the answer to that is, while it can become a permanent establishment, it is not necessary that just because you have a subsidiary, it is a permanent establishment. Right? It depends on what is the nature of work that is done by this company or the branch. What is the tenure of the work or the period for which this work has been done. Generally, if the nature of work is something which is preparatory or auxiliary, and we will have a detailed discussion on this in terms of what preparatory and auxiliary is in one of the succeeding sessions, then typically a permanent establishment does not come into picture. A preparatory work is something which is in preparation to the main activity of the non-resident. Whereas if the work is something which is directly linked to revenue generation, then in that particular case, this will constitute a permanent establishment. Similarly, if the period for which the work is done is a very short period, it's of a casual nature. So you come, someone comes from the non-resident, comes to India, does the work and goes away. And it is not very, very significant in terms of the revenue generation. Then a PE may not arise. Whereas if the transaction is done on a regular basis over longer period of time, then it can result into a PE. Again, depending on the nature of work, what is the relevant tenure? That is something that one again needs to look at. So when we talk about a permanent establishment in the source state, and source state is the one generally where the customer is located. So when you talk about the existence of a permanent establishment in the source state, it typically gets due to three different factors. One is if the non-resident has an office in the source country, let's say India. If the non-resident has a company, the company pays the taxes. Depending on the nature of activity of the Indian company, a PE may or may not arise. The second is the concept of an agent. Sorry. So an agent actually may be again classified into a dependent agent or an independent agent. We would see the difference between these two when we come to agency PE tomorrow. And the third could be when a non-resident does not have an office, he does not have an agent, but they are providing some services on the site. These services could be installation services, there could be construction services, or otherwise. Right? Now, a permanent establishment can arise either under the local laws. In India, it is the Income Tax Act 1961. And if everything goes right, maybe we may have the new Income Tax Bill 2025, which may replace this act. Now, when it becomes effective is something which is, again, different. Or it could be the local laws of any other country. So let's say if you talk about UAE, it is the UAE corporate tax law. That is something that governs the existence of a permanent establishment. The second is the applicable tax treaty. If the country where the activity is being done has a tax treaty with the country where this person is a resident, right? Then this treaty may also contain when the permanent establishment clause could be triggered, or even both of them could be there. So you may have a PE clause under the local laws, you may have PE clause under the applicable tax treaty, or you may have it under both. Now, one question that I have is, from an Indian standpoint, do we have a permanent establishment in the local laws, in the applicable treaty, or both? Can you just answer this question in the chat box and let me know as to what your thoughts are? Do we have a permanent establishment under the Indian local tax laws, under the Indian tax treaties, or both of them? So we've got two answers, which is both. So actually it's right. Under the Indian local laws, we have section 92F, which contains the definition of permanent establishment. In the Indian tax treaties, we have Article 5, which covers the definition of permanent establishment. So actually under both the local tax laws and the applicable tax treaty, we have the definition of permanent establishment. The same is also the case for UAE corporate tax, because in that case also you have the permanent establishment both under the UAE corporate tax law as well as the tax treaties which are entered into UAE. Now, whenever you look at a permanent establishment, the simplest thing to look at it is, if based on your facts, let's look at one matrix which basically helps you to decide as to what you should opt for. So if you have a permanent establishment under both the local laws and the tax treaty, in that particular case, first you should evaluate if, based on your facts, there is a PE under the local laws. If there is a PE under the local laws, then basically you should evaluate if you have a PE under the treaty. If you have it under both of them, the clause, then you should evaluate if, based on your fact, can you claim an exemption under either of them. And if you can, you should opt for that particular provision. As against this, if there is no PE based on your facts under the local laws, you can opt for taxation under the local laws, and therefore, as a non-resident, you are not required to pay any taxes, even though you may have a permanent establishment under the tax treaty. The reverse is also true, where if you have a PE under the local laws, but you don't have a PE under the tax treaty, again, there is no tax that you are required to pay. So it is only when you have a PE under the local laws as well as under the under the tax treaty that you are required to pay taxes. Now, under the local laws, there is another concept in India of something called a business connection. Right? We will come to that in a short while. But that is something that basically, again, kind of decides in terms of what is required to be taxable under the income tax laws. Now, let me ask you another question. And this is also, I think, because we are covering the basics, this is also quite important from the other perspective. If there is a US company which is doing business with India, right? What would their preference be when putting in Article 5? Would they want that only the state of residence should have the right to tax, or state of source should have the right to tax? So basically, state of residence is the state where the concerned taxpayer is a tax resident, and state of source is this place where the person who is actually doing the transaction with the non-resident stays. Any thoughts? So basically, all the tax treaties that are, and this is also the answer to the difference that will come in when you look at the OECD model and the UN model. So OECD model is the Model Tax Convention. It's a standard agreement, standard tax treaty, which is developed by the members of OECD, which they use when they enter into tax treaties with other countries. Whereas UN, so it is mainly in respect of the developed countries. Whereas the UN model is slightly more balanced, and it is considered as a starting point by the developing companies. And the reason is that the OECD model, where the developed countries are, they prefer to have a permanent establishment clause where the state of residence has the exclusive right to tax income. Whereas the Model Tax Convention in UAE, when it deals with permanent establishment, tries to seek a balance whereby even the country where the income is accruing or arising has a right to tax the income. Right? So in this particular case, basically, when we look at the Indian tax treaties, they are more based on the UN Model Convention. So coming back to our particular example, a permanent establishment can arise when a foreign company operates either through an office of the non-resident. Now, when we say office of the non-resident, it does not necessarily mean that they have to be owning that office. Even if it's a rented office, that can still constitute a permanent establishment or a fixed place of business. This fixed place of business can be anything, right? As long as it is a geographically identified area from which the non-resident operates, this place can constitute a permanent establishment. It may be owned by the non-resident, it may be rented by the resident, it may be the office of the subsidiary also. Depending on the facts of the case, even they can constitute a permanent establishment. The second is the case of an agent. Now, how the agency concept came into being was that when a non-resident realized that if they have offices in India, they might constitute a permanent establishment, they hired agents who could be a person resident in India to do the activities which they would have otherwise done directly themselves through their employees. So within the agents, there is a concept of a dependent agent and an independent agent. So Rachna, even if the place is owned by the customer, so long as the non-resident has the right to use that particular place, and that then it can constitute a permanent establishment. We're going to look at all these answers tomorrow as we deal with the fixed place of business PE. And whatever questions you have, what we will do is towards the end of the session, we will discuss those questions and answers as well. And the third could be a business site, which could be a construction site, an installation site, right? And many others that we are going to look at tomorrow. Now, like I discussed, the taxation of business profits and PE. So basically, business profits is something which is dealt with in Article 7, and permanent establishment is something which is discussed in Article 5, right? So when it comes to taxation of business profits, the business profits can be taxed in the state of source. Let's say if we take the example of India, only when the non-resident has a permanent establishment in the source state. This permanent establishment could be either under the domestic tax laws, which, for example, in India is the Income Tax Act 1961, or it can be the tax treaties which are entered into by India. The process to be followed is you first look at the domestic tax law provision. If there is a PE, you go and evaluate the treaty. But if there is no PE, then the income is not taxable. If where you look at the treaty and there is a PE, the business profits are taxable. If there is no PE, the business profits are not taxable. Now, having a PE is not the end of the world. There is one more important aspect which we will be covering in session 4. Even if a non-resident has a permanent establishment in the source state, let's say India in this particular case, the taxation of business profit is not for the entire profits that the business might have earned. In the example that I told you, we had $100 worth of sale and $80 was the cost. So the profit was $20. Now, there is a fact-finding exercise that is done whereby you identify what are the activities that are contributing to the earning of this profit. Out of these activities, which of the activities are done in the source state and which are done in the state of resident. While it may be too simplistic to allocate the profit this way, but the rule in permanent establishment is that even if a non-resident has a permanent establishment in the state of source, only the profits which are attributable to the activities in the state of source can be taxed there. So let's say, for example, if we were to assume that out of this $20, the profits related to activity were 5 for this and 10 for this. If in the state of source only activity 1 was done, then the profits that can be taxed here is only 5, and the remaining 15 will be taxed in the state of residence. The right to tax, even if a PE exists, is only in respect of the profits which are attributable to the permanent establishment. If the profits are not attributable to a permanent establishment, nothing can be taxed, right? And when arriving at these profit, if there are any transactions between related parties, Then transfer pricing provisions kick in, and the transactions have to be stated as if the two parties that were dealing with each other at arm's length. So once that is done, the correct profit is ascertained. It is attributable to various activities, and only the profit which is attributable to the activities of the PE will be taxed in the state of source. One more point, which is, let's say, for example, the tax on the income of 5 in the state of source, I'm just taking a broad example, is 2. Let's say the state of residence taxes the entire 20 and the total tax payable on this 20 is 5. Normally, the way it works is that if the total tax payable in the state of residence is 5, they are going to reduce the tax already paid in the state of source, and only the remaining amount has to be paid to the state of residence, which means that the total tax of 5, the cash flow for the taxpayer remains at 5. $2 they pay to the state of source, $3 they pay to the state of residence. The total cash flow still remains at 5. Problem, of course, comes in when you pay taxes here, but here, because of losses and everything, the tax is no longer payable, in which case this too may become a dead cost for you. But that is something which is dealt with in Article 23, elimination of double taxation. So for those of you who are a part of that particular course, you would have seen that this particular amount is something which is available as a credit against the tax liability in the state of residence. Now, if we look at the Indian law, basically, there is a concept of something which is called the source rule. Under the Indian Income Tax Act 1961, the source rule is something which is given in Section 5 and Section 9. Because we are dealing with the concept of PE, so I would not be getting into the details in terms of, the entire thing here. But Section 5 basically provides as to what are the income of non-resident which will be taxed in India. And it says that any income which is either received in India or deemed to be received in India, there's a detail in terms of what gets covered here. Any income of the non-resident which accrues in India or arises in India or is deemed to accrue or arise in India is taxable in India. When we talk about income which is deemed to accrue or arise in India, one of the important clauses here is that if there is a non-resident has a business connection in India, and we will see what this means in the next slide, then any profits which are attributable to this business connection would be taxable in India. Now, the interesting thing which we need to discuss or consider here is, even if there's a business connection, that would only mean that the non-resident is going to get taxed on the business profits under the Income Tax Act, which was part 1 or step 1 of what we discussed earlier. A non-resident also has the option to opt for the tax treaty provision, right? When we say tax treaty provision, what that means is, if the tax treaty between India and his country of residence has a PE clause, even though if he forms a business connection in India, if the PE conditions are not met, then he doesn't need to pay any taxes, even if his income is covered under either of these categories. There is no exhaustive definition of permanent establishment insofar as the Indian domestic tax law is concerned. So basically, this is what the concept of business connection looks like insofar as India is concerned. And when we look at the domestic tax law of many other countries, they have similar clauses. Now, basically, when we talk about business connection, or for that matter, the domestic tax laws of any country, you would find a situation where they also contain clauses similar to the ones that are contained in the tax treaty. But in most, if not all the cases, wherever international tax is something which is looked at by the governments as a serious mode of collecting revenue, the definition of permanent establishment in the treaty, in the domestic tax law, or for that matter, the equivalent of that as business connection in India, is much more wider than the treaty definition. At the end of the day, look at it like this. A and B wanted to enter into a contract. And A and B, let's say, are the resident state, the state of residence and the state of source. Now, if the state of source itself says that only A, B, C, and D will constitute a PE, why would B come and negotiate with them to say, no, let's have something called E also here? Generally, these tax treaty would contain something which will be lesser than what is contained in the domestic tax laws, right? And that is where the entitlement to treaty becomes very, very important. Now, while that is not something which is a matter of discussion over here, generally for tax treaty benefit purposes, now most of the countries want that you should have something that is called a tax residency certificate at the minimum, which should be available before you can claim the benefit of the tax treaty between any two countries. So this tax residency certificate is required, and generally, let's say in US, the US IRS issues it. In UK, the HMRC issues it. In UAE, the FTA issues it. In India, the Income Tax Authority issues it. This is basically a certification of the fact that you are a tax resident of that country. But is it a guarantee that the other person may not dispute it? Obviously not. It's not a guarantee. But generally, when you want to claim a tax treaty benefit, this is the minimum document that is required. In addition to this, if you are earning business profit, a no PE declaration is also something which is requested for by most of the people. And the reason why declaration is important, and why I think, I missed this point initially, I should have discussed this. The reason why the concept of PE is important is, if you have a permanent establishment in another country, then your business profits may be taxed at 35%, let's say in India, or the same corporate tax rate that may be applicable in that country. As against this, if you don't have a permanent establishment, then certain incomes that you are getting may actually be taxed at 0, 5, 10, or 15%. And when I say certain income, I'm referring to royalty, fee for technical services, dividend, interest. All these income, wherever the relevant clauses are there, they have a clause in the treaty that if you don't have a PE, then only the tax rate of a lower tax rate is applicable. Of course, the key difference that one needs to be clear on is all these rates of taxes are on the gross amount which is sent, whereas this 35% is on the net income that you earn. So sometimes, actually, if you see, and this is what I've seen in many of the cases over the last 24 years, if you would have actually had a PE and you were paying taxes on net profit, the amount of tax you might have paid might be lower. But the simple fact that if you have a PE, you are subjected to a much closer scrutiny and you have to do all the tax compliances, deters people from actually even accepting this, and they're happy to pay maybe 0, 5, 10, or 15%, thinking that they may be able to claim some part of the tax paid in India as a credit in their host jurisdiction. So looking at the business connection point here, basically any income accruing or arising in any place outside India. Now, when we talk about the concept of business connection, what it means, what it says is, if the income was accruing in the source state, let's say India, in any case, it is taxable in India. This concept of business connection as it is there in the Indian tax law is meant only in cases where the income is accruing outside India. If income accrues outside India, whether directly or indirectly, through a business connection in India. And what is a business connection? We'll just look at it. Or from any property in India. So let's say if a non-resident has an immovable property in India, or through or from any asset, let's say if you have a fixed deposit or source of income in India, or through the transfer of a capital asset situated in India, this income is deemed to accrue or arise in India. Even if it is accrued or arisen in India, you can always go back and look at the tax treaty provision to see if you are eligible for an exemption under those provisions. These are some of the examples which may result into a business connection in India, right? We will be discussing each one of them in detail as we go through the various forms of permanent establishment. So I would just quickly maybe look at these. A non-resident, if they appoint an agent in India for selling goods, such an agent can be a business connection. If a non-resident is engaged into regular supply of goods to Indian customer through a warehouse in India, that can constitute a business connection. Now, please note one thing. This is a business connection. Now, depending on the activities which are done in India, some or entire income may be taxable in India. So when I say a business connection in India, it doesn't mean that this non-resident is liable to tax in India. It may be liable to tax in India. Construction projects executed in India. And if you are looking at some other country, you can just substitute India for that particular country. Services delivered to an Indian client by employees or subcontractors in India. Now, this brings an important point here that to have a permanent establishment, it is not necessary that your job is done only by your employee. Even if you have subcontractors, even if you have third party, even if you have agents, they can also constitute a business connection in India. IT, marketing, and client support outsourced to India, that can constitute a business connection. A business partially managed from India, revenue from Indian customers and local promotions, collaboration with Indian companies to render services to Indian clients and overseas clients. So if the Indian company is providing services to Indian and foreign clients of a non-resident, then that Indian company can constitute a business connection. Regular sales within India with pricing controlled by Indian personnel. This could be a salesperson or an agent. Software and support services to Indian clients in India, and activities exceeding liaison function. Now, typically when there is a liaison office that a non-resident operates in India, that generally does not constitute a permanent establishment. But then there are various provisions as to what activities can be done by a liaison office. If the liaison office actually exceeds the scope of work from those activities, they can still constitute a permanent establishment in India. Now, when we talk about PE or business connection, some aspects which are to be considered at a generic level, and that will be applicable irrespective of the type of PE, is whether there is a continuity and regularity of operations. So a single transaction done by a foreign company may not necessarily result into a PE. And in this context, one of the cases that were there is that a foreign company comes to India and organizes a golf event, right? Where they were held that they do not have a permanent establishment. So you have to see, is there a continuous set of actions or operations being done by the Indian company on behalf of the non-resident, or the non-resident is doing it directly? Are the operations regular, or they are just a single one? If the operations are on a continuous and a long-term basis, then obviously the risk of having a permanent establishment increases. The frequency of transactions. If you do multiple transactions over a short period of time, then that can be something which can also result into a PE, whereas a single or a sole transaction is unlikely to result into a PE. Is there a commercial connection contributing to the non-resident profit in India? Now, sometimes the activities which are done in India may not necessarily be contributing to the commercial enhancement of the non-resident, right? So let's say, for example, one of the common examples that comes up here is a non-resident which is engaged into manufacturing sources raw material from India. And they basically source raw material continuously and they sell it out for their own manufacturing purposes. In this case, this is something which is carved out as an exception, right? Indirectly, you may say that this is something which is still contributing to the non-resident profit, but whether it is contributing directly or not is something that needs to be looked at. Indian agent is not necessary to constitute a business connection. If you have a business connection, you can even have it through other means also. It's not necessary that there has to be an agent. And absence of any operations in India. Now, this is an important question. And I would like to ask you, does the existence of operations in India contribute to the existence of a PE? Maybe I think, let me ask a question on poll because that may be an easier one. So here's a short poll that is there, and maybe, you can just answer this, because this is something which, many people, when they look at permanent establishment, they tend to ignore this particular aspect. Does the existence of operations in India impact a non-resident taxability? So let's say you have a business connection in India, or you don't have a business connection in India, right? Okay, let me just dictate the question if you're not able to see it. So basically the question is, if there is no operation in India, can there be any impact from a business connection or a PE perspective? Okay, maybe next time we'll have a better set to use these questions. Now, the absence of any operations in India from a business profit perspective, from Article 5 perspective, is very, very relevant. Because as I told you in one of the preceding slides, what can be taxed in India is only the business profits attributable to the PE in India. If there are no operations in India, even if there is, then in that case, these profits are not going to get taxed. The situation is different if you are paying royalty or FTS to a non-resident. There, whether or not you are doing operations in India, it doesn't matter. The taxability is more dependent on who's the payer, who's the recipient, what is the payment for, and whether it is covered under the tax treaty or the Indian Income Tax Act. But insofar as business profits are concerned, if there are no operations in India, then the taxability would not arise. Do we have any questions that you would like to take? So Vishnuvardhan, basically, if a foreign company provides services through its consultant who are non-resident for more than 120 days, then it can be treated as a PE, treated as PE. If so, under which, so it depends, just because you're providing the services through a consultant, it doesn't matter or doesn't make any difference to the existence of the permanent establishment. Sorry. Yeah, sorry. So the question was, if a foreign company provides services through its consultant who are non-resident for more than 120 days, then can it be treated as a PE in India? The existence of a PE is not dependent on whether a person who's providing the services is your employee or he's a consultant. What you need to see is he operating through a fixed place of business in India, in which case he can constitute a PE. The second is, if you want to look at it from a service PE perspective, Then you just need to see the relevant tax treaty to see how many number of days the services should be rendered in India to constitute a permanent establishment. Based on these two factors, you can decide as to whether there's a fixed place PE or a service PE, right? The second question is, payment is made from Chandra Vijay. Payment is made to a marketing consultant of a country with which India has not entered into tax treaty. He has rendered professional services outside India. The overseas consultant does. Chandra Vijay, we will want to take questions relating to permanent establishment only. But just in the brief to answer your question, even if there is no PE, if these services may actually be covered under FTS and may be liable to tax under the Income Tax Act. Does secondment create PE risk? Rachna, it all depends on what the contract is. What is the secondee employee doing? Is he pursuing the interest of the Indian entity? Is he pursuing the interest of the foreign company? It could be both ways. There are many cases which are there around where secondment has resulted into a PE and has not resulted. More of this we will see when we discuss the service PE aspect. Yeah. Do we have more questions? Or maybe we can just look at this particular slide as well. So even if you have more questions, what I would suggest is, so long as they are relating to what we have discussed today, you can always just go back and put them into this particular community section, which would be there for you. You would have access to this because you're all subscribed to the PE course. For those of you who are not subscribed, basically then in that particular case, this would not be available. But for those of you who are subscribed, you can always go back and ask these questions here over the course of next 3-4 days. And what we will do is we can take the questions from here as well. You can ask them during the call as well. If you have some questions which are discussed afterwards, we can even look at them and discuss it as we start our next session. So before we wrap up for the day, I think we'll just look at this particular slide, which is relating to the concept of an agent constituting a PE in India under the provisions of the income tax law. So if a non-resident carries out the business activity through an agent, that can also constitute a permanent establishment. But the agent has to fall under either of these three categories. The first is an agent who, acting on behalf of the non-resident, has the authority to conclude contracts in India. Right? So let's say a non-resident is engaged into manufacturing of electronics goods. And there is an individual in India who goes to various customers, tells them about the product, discusses and negotiates the contract with them, and then concludes the contract. Now, this conclusion itself may either be the actual signing or it could be that he plays the principal role leading to the conclusion of the contract by the non-resident. And when we say he plays the principal role, what that means is that basically he does everything except the signing part, for which a non-resident may be signing the contract themselves. As long as he discusses it, as long as he informs them about the things, as long as he negotiates the contract, just because the contract is concluded or signed outside India would not mean that this agent will not constitute a business connection in India. The second case is that of an agent whom habitually maintains a stock of goods or merchandise in India for the non-resident, and he delivers the goods on behalf of the non-resident. So let's say, for example, in this very case only, if this individual kept a stock of these goods and he sold them in the name of the non-resident, this person, then this person may constitute a business connection. But if he purchases the goods from the non-resident and then sells it in his own name, and the transaction is not an anti-abuse transaction, whereby, all this has been just showcased just to avoid taxation or business connection, then in that case, if he does it on his own account, genuinely, he will not form a business connection. But if he does it in the name of the non-resident, he will constitute a business connection. The third one is if he habitually secures orders in India, either mainly for the non-resident or wholly for the non-resident, or for companies which are affiliates of the non-resident, then this agent can constitute a business connection. The exception in the Income Tax Act is that if a person is acting in the ordinary course of his business, either as an agent, a broker, a commission agent, etc., right, then he can constitute an independent agent where he would not constitute business connection. But if he again works solely for one particular company or on behalf of affiliates of that person, he will not be considered as an agent of independent status. Needless to mention, even if an agent becomes a business connection, it is only the profits which are relating to the activities of the agent that will be taxed in India. With that, we come to an end of this session. And because we have a hard stop at 7, right? Okay, let me take this last question. Certain jurisdictions allows us to do business only if there's a local presence or through an agent, role of agent. You need to see the relevant tax treaty, Rachna. If you look at it, the anti-avoidance provision and everything, this should constitute a PE. But again, you just need to see the relevant tax provisions as well. So with that, we come to an end of the session today. You will, like I mentioned, you would have already received the link for the section tomorrow, for the tomorrow's session by now. And you would also get a reminder half an hour before the call. If there are any questions, feel free to write them in the community section. The recording of the session will be uploaded tomorrow because then it will be processed. And either tomorrow or maybe in a few days, it will be there. Along with one of the person had asked for the